information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the GoldMoney Foundation podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair Macleod on behalf of GoldMoney, and with me on the line today is John Butler, who is Chief Investment Officer at Amphora Commodities Alpha Fund. And prior to this, John was Managing Director and Head of the Index Strategies Group at Deutsche Bank in London. He writes the Amphora Report, which is a regular newsletter issued by his company. He also published a book, The Golden Revolution, earlier this year, predicting a return to a gold standard and why the days of a fiat dollar are numbered. This should make for an interesting podcast. Before we get into gold and the reasons it may return as money, tell us about your fund, John, and your current investment strategy.
Well, the fund is designed as an answer to some of the new questions and risks that have arisen following the financial crisis that began in 2008. And basically there's this huge debate going on in financial markets about whether the outcome of the general deleveraging of the system that began in 2008, is that deleveraging going to occur in a deflationary way, that is through some combination of debt restructuring and default, or is it going to occur in an inflationary way, that is by the real value of debt being eroded by inflation over time? And there's a huge debate back and forth about which of these two forces is stronger, which will prevail, and so forth. And I think that what is lost in that debate is that there are certain common elements between the two. And if you look at history, it almost doesn't matter whether a deleveraging is primarily deflationary in nature or inflationary in nature. In both cases, what you find, and this is based on original research I have done, is that financial assets in general underperform commodities, including gold. And there are various reasons for that, the simplest two of which are that in the event there is inflation, commodities hold their value better than financial assets. And if there is deflation, you get outright credit default, something which cannot occur to a basic raw substance or commodity. So my fund is very much designed to try and outperform in a deleveraging environment, regardless of whether it is specifically inflationary or deflationary, and it does so primarily through allocations to specified commodities.
I suppose that there are some commodities that, whatever happens to the world, we're still going to need. Does this come into your thinking?
Absolutely. And in fact, if you want to hold a commodities portfolio which is specified to a relatively weak global economic outlook, well, then you can go about that in various ways. But let me give you an example. If you're trying to build a new factory or a new house, for example, it's going to take a lot of new materials, say certain metals, for example, and certain other substances will be required, and you may not be able to acquire those by simply recycling those already in existence. You'll have to pull new ones out of the ground and go, put them through their processes and refine them to the point where they are usable for building that new structure. But let's say you're not building any new structures. Let's say global economic growth is very weak and you've simply got your existing factories and your existing homes and you're not adding any new ones at all. There's no growth in the capital stock. Indeed, let's say there's no growth in GDP. Well, you'll still need oil simply to fuel the existing capital stock, the existing factories. So in a zero growth environment, you're still consuming oil. In fact, in a negative growth environment, you're still consuming oil, but you're not necessarily consuming as much in the way of industrial metals, for example, that are used in construction and in creating new capital goods and things of that sort.
Right. Now that, I think, makes an awful lot of sense. It helps perhaps justify something that James Turk shows as a chart, and that is the price of oil in gold and how stable that is compared with the price of of oil in fiat money. So I could see that makes sense. So presumably within your portfolio strategy, you must be looking at three things. You must be looking at energy, obviously, because we need energy, food, because we need that in order to exist, and presumably gold, because that is the money of choice of societies around the world, across the globe, rather than a fiat currency, which tends to be restricted to one particular small portion of the globe. Does that description give you a background, the sort of background that you consider?
Well, we do look at a broad variety of commodities. The point being we're trying to achieve maximum diversification within what we consider to be a defensive commodities portfolio. That is, overweighting systematically those commodities that are least correlated to the growth cycle and that will hold their value better in the event that growth is chronically disappointing. But gold plays a special role in that. And as you point out, gold is a universal money. It has remained a universal, call it alternative money, ever since the formal link between currencies and gold was severed in 1971. And in fact, if you believe in the arguments put forth in my book, in fact, the world is making its way back towards a gold standard in a process which is to some extent crisis-driven, but to some extent does not necessarily have to be crisis-driven. There are ways in which we could move back to gold that aren't necessarily requiring a crisis to be catalyzed as such. But yes, gold plays a very special role because it is re-emerging as a form of money, universal money. And that demand for universal money, the demand function, as it were, for gold necessarily shifts as it becomes remonetized in various ways, if not remonetized in the day-to-day sense that you and I might think about it, that is using gold coins for actual transactions. But there are other ways behind the scenes in which gold is indeed becoming remonetized. That shifts the demand curve, and we think that will be very favorable for the gold price going forward.
I was interested that there's a report recently released that there are more millionaires in the Asia-Pacific region than in North America, and that also storage of gold and silver is migrating east, with Singapore and Hong Kong expanding quite rapidly, and certainly a lot more rapidly than any expansion of facilities in the West. So there's a geopolitical, maybe, a geographical shift as well, and presumably this opens up whole new avenues of demand, with China, for example, having only recently allowed its citizens to buy gold. They're accumulating at quite a rate. Presumably this you would see as having quite an impact on the price of gold and silver in the future.
Oh, I absolutely think it will, and it will in ways that are direct. That is simply the fact that demand in Asia is growing, as you point out, but also ways that are a bit subtle and indirect. For every Asian investor, for every new source of wealth in the world that decides to accumulate some gold rather than merely accumulate dollars, you also have a shift in the demand function occurring for dollars. The problem there is that there's really no backstop for the dollar. It is a fiat currency, and because there is no intrinsic value behind it, to the extent that preferences are shifting in favor of gold in, say, linear fashion, in fact, you could see that being reflected in a non-linear loss of confidence in the dollar, because the dollar is the primary beneficiary of reserve currency status. So, for example, not only are the Chinese acquiring gold, but Chinese businesses and the banking system, and indeed the central bank itself, is diversifying reserves within currencies out of dollars into things like the Japanese yen, for example, and also other trading partners of China in local trading partners in the region with which China does increasing business. And so I think you're seeing two things happening there. It's not just the demand for gold's going up, it's the demand for dollars is going down. And the dollar is the single most vulnerable currency in the world to this demand shift in favor of gold because of that reserve currency status it still enjoys.
That is interesting, because at the moment, I think if you ask the man in the street, he would say the most vulnerable currency is probably the euro. How do you see that affecting things?
Well, the euro is in the headlines, and to be fair, it's in the headlines for the right reasons. I don't want to suggest that what's happening in the euro area is not very, very serious. It is. But the euro has simply never acquired the reserve currency status that the dollar has enjoyed as a legacy of the Bretton Woods system. Now, that doesn't mean that the euro doesn't have issues which will cause investors to want to diversify out of euros and reduce their holdings of euros. But to some extent, I think the focus on the euro area is a bit too exclusive. If you begin to compare the euro area in aggregate to the United States in aggregate, federal, state, and local government finances, well, actually, the United States looks worse in just a simple comparison of things like debt to GDP ratios. And in fact, it looks much worse when you begin to look at the external deficit run by the U.S. Not only are its finances just as stretched as the euro area, but they are even more financed abroad, and therefore the dollar is even more vulnerable to a shift in the global demand function for dollars than I believe the euro is to a shift in the global demand function for euros.
So it boils down, from what you're saying, to external ownership of fiat currencies, which only naturally have an issuer's promise, if you like, behind it at home. The thought occurs to me from what you're saying that there is an interesting parallel, surely, with the run-up to the Nixon shock, because America had wound down first the Korean War, and then wound up and then wound down the Vietnam War. And in the Bretton Woods environment, a lot of those dollars started to come home via the central banks and were repatriated to America in return for gold, particularly by the French central bank. So what you're suggesting is that we're having, in a different way perhaps, a rerun of that situation is potentially overhanging the dollar itself and could well spur demand for gold over the coming year or two or three.
Well, absolutely. I mean, there is definitely a parallel with Bretton Woods. Back then, of course, the dollar was backed by gold, and so, as you point out, as foreign central banks and also private investors began to feel that they had accumulated excessive dollars, they were beginning to exchange those dollars for gold. And France was obviously very prominent in this regard because President de Gaulle himself came out and said that France no longer felt that the Bretton Woods system functioned in its national interest, and he was going to demand a repatriation of France's gold reserves, which was finally done a handful of years later. But in any event, what makes it an interesting parallel for today is that if the same sort of thing happens today, and I see signs that the same sort of thing is happening today, well, then it's not as if you can cash in those dollars for gold now, right? You've got to find something else because the dollar is no longer convertible into gold. So look what China's doing. They're cashing in their dollars for natural resources, for example. They're buying up mines, they're buying up oil fields, and they're also trying to acquire a more modernized military to help protect those assets. That's an entirely logical long-term strategy for reducing their dependence on the dollar. And while they may be the largest actor in that regard, there are many smaller actors out there who are doing similar things. But as I mentioned earlier, as we get further down this road of people trying to move away from the dollar, the United States becomes much, much more vulnerable because it does depend to a far greater degree on external financing than all of the other major currencies, including the euro, including the yen, and of course most minor currencies as well. In fact, Spain in many respects is the economy that most closely resembles the United States. Spain ran a huge current account deficit through the years that the euro was in existence, and that current account deficit is one key reason why things are as bad as they are in Spain today.
That's an interesting comparison, and certainly Spain had a property bubble in the same way that the US had, and they've both popped. You've got large deficits leading to growing levels of outstanding government debt, and that is an interesting comparison. Do you see, certainly after this election year, nothing's really going to happen in America in this election year, but do you see them ever tackling this huge, great budget deficit, which, unless we get economic recovery in the States, surely is looking like it'll just continue to grow. And what do you feel about the prospects of economic recovery in the United States?
Well, the United States economy now has deep structural problems. I mean, don't get me wrong, there are many economies around the world with deep structural problems, but the United States does have those problems. And what's interesting with the United States is that historically it was always regarded as the more dynamic economy, the less regulated economy, the more purely capitalistic one, the one that had the smaller government sector, and so on and so forth. But those distinctions don't apply nearly as well today. The United States in many ways does not look exceptional now in that regard. And really, as I've been saying for several years, the United States is in process of becoming what I would call a normal economy, one that is not held in this higher regard vis-a-vis the rest of the world. And certainly the chronic budget deficits that we're seeing now and the explosive growth of entitlements is an example of that. The other side of it, though, is the political process itself. And the political process in the U.S. is becoming increasingly dysfunctional. I mean, no one is willing to make the hard choices that would be required to stabilize U.S. finances. And perhaps one reason why that's the case is because those hard choices have become so unbelievably hard. By some measures, the U.S. is, in fact, in a debt trap already. And there is just no set of policy choices other than beginning to selectively default on the debt that could possibly stabilize U.S. finances. So it's really come a long, long way over the past couple of decades. And so do I think there's much hope that some visionary U.S. politicians will decide that they really do need to face these problems as large as they've become? I'm not terribly confident in that regard. I think it's going to have to be a day of reckoning when all of a sudden the dollar's demand function around the world shifts very dramatically in favor of some combination of gold and other currencies, and the U.S. is suddenly unable to finance itself. It's unable to finance itself because it loses its external creditors. They simply will not accumulate any more dollars. And at that point, the United States will either have to allow the dollar to devalue very, very dramatically, or it will have to raise interest rates very, very dramatically to defend the dollar. And that will be a very difficult choice to make.
So this brings us back to the heart of the theory behind your investment management approach, and that is deflation or inflation, effectively. We see, I think, from what you're saying, a very difficult choice, which is likely to follow the easier process of printing money to kick the can down the road, as the cliche goes, rather than face up to reality and allow government departments to allow businesses to go bust, to cut government spending, to really take the axe to what government actually does. And so we're really back to the inflation-deflation debate. And from what you're saying, the inflation is going to win out over deflation.
I do believe that's true. I do believe that is true. And there is this thinking out there that somehow it is impossible for central banks to create inflation. That is, if there's going to be deflation, it's going to happen. The central bank can try to mitigate the effects it has on the banking system and can stabilize things with occasional injections of liquidity, but it cannot stop the deflationary process from nevertheless playing out over time, as some argue it has in Japan. I'm not sure that's true, and the reason I think that's not true is because history shows you that if you're willing to change the rules, that in fact you can create inflation. I mean, for example, some people say, well, the Fed is already buying treasuries and holding down yields, and that hasn't really created much inflation. Well, they can buy more. In fact, the Fed could buy the entire treasury market. And if that doesn't create inflation, they could buy the entire corporate debt market. And if that doesn't create inflation, they can buy the entire household debt market. And if that doesn't create inflation, they can start buying commodities. And then by definition, there's direct transmission from Fed policy into rising consumer prices. That is inflation. And people say the Fed would never do that. Well, we've seen central banks do all kinds of crazy things through the decades. And the Fed may have been somewhat more responsible than most on average, certainly compared to Zimbabwe, but But who knows what the future holds? And if the U.S. is unwilling to make hard choices, it will always come down to the Fed being leaned on to do a little bit more, a little bit more, a little bit more. And will always end up creating inflation if you're willing to change the rules.
But I suppose this is already happening, isn't it, John, in the sense that the Fed may not be running out and buying commodities, but the Chinese are buying commodities and dumping their dollars as a result, or if you like, trying to manage their currency, I should say, so that it doesn't rise too much against the dollar. So you do have, I suppose, by one step removed, this leakage of paper money into the purchase of commodities.
Indeed, you do. And in fact, in my book, I argue that it's precisely this sort of activity, that is, around the margins, countries large and small around the world taking incremental actions to try and reduce their holdings of dollars and increase their holdings of other currencies or raw materials and commodities, including, of course, gold. We see an increasing number of central banks doing precisely that. And you get into a situation here where you already have an unstable monetary equilibrium. More and more actors around the world understand that the debts that have been accumulated by the United States and other developed economies are simply not serviceable at current face value. They're going to be devalued in some way, shape, or form. And so there's a first mover advantage in reducing your holdings of this paper, these currencies that are going to be devalued. Well, as soon as a few small actors start changing behavior around the margin, they increase the pressure on everyone else. For every country out there that slows its accumulation of dollars and acquires some gold instead or whatever else it might be, well, there's someone else who's going to have to step in to fill that gap. And if they're unwilling to accumulate even more dollars in response, well, then the demand curve for dollars shifts, and it shifts in a way that will put downward pressure on the dollar. And eventually, of course, enough of these smaller countries have changed policy that you're left with only a small number of large countries that are the only ones still willing to support the dollar. And then you get into a sort of prisoner's dilemma, a really ugly sort of game theory situation where everyone has an incentive to defect and be the first to defect from that system. And then the whole thing collapses. There's no way to predict precisely exactly where that tipping point lies in the future. But given the speed at which things are unfolding now around the world, I don't think we can make it through another couple of years without this equilibrium shifting very suddenly and surprisingly away from the dollar towards, well, some sort of alternative, which in my book I argue is going to be a gold-backed alternative.
Well, that is interesting because that puts the pressure on the banking system in a very, very fundamental way. The banking system basically operates entirely on fiat currencies, and anything that they do in gold is rather a sort of side issue. They may use it for collateral a little bit. And you picked up, with respect to collateral, that in an article that you wrote fairly recently for the Amphora Report, that the central banks, the Bank for International Settlements, is going to allow in Basel III the use of gold as a Tier 1 asset. Now, tell us a little bit about why that might be important.
Well, it's important in principle because gold is, in effect, discriminated against within the banking system because of the risk weighting that it has. Government bonds, at least if they're highly rated government bonds, receive a zero risk weighting, so banks can accumulate essentially as many government bonds as they want without having to hold any sort of loss reserve against it. The same is not true with gold, which has a 50% risk weighting. And so you do have to hold some sort of reserve against potential losses in gold. And that's a capital charge. That's effectively a charge against banks' capital. And now banks are, however, kind of stuck between a rock and a hard place at the moment because on the one hand, regulators are telling them you must increase your capital ratios. They're too low. But then on the other hand, regulators are also saying, oh, please keep lending because we want you to help stimulate growth. Well, look, you can't have it both ways. I mean, you can't both be trying to improve your capital ratio and go around lending money to risky borrowers at the same time. It doesn't work. There is, however, a third alternative, and that third alternative is to increase the basket of zero-risk assets. So you give banks something else they can hold that does help, that gives them an alternative for building up those capital ratios but which would not necessarily go directly against their ability to extend new credit. And so that could be gold. And so the banks are saying, okay, fine, you want us to raise our capital ratios, but please give us additional flexibility to do so, because way too many bond markets out there are no longer rated highly enough to be eligible for that zero risk weighting. So it's interesting that some of the initiatives, some of the impulse to try and get back to some role for gold in the banking system is kind of happening naturally within this context. It's not because some master planner decided to start going about doing it this way. It's true bottom-up pressure of people seeing the potential value in remonetizing gold in this subtle way. And I think that when you combine that with what's happening more in the official sector and official policy and trying to diversify out of dollars and central banks buying gold, you add it all together, and it does suggest to me that we have a far greater dynamic pushing the world back towards gold than is generally acknowledged.
That is very interesting. On a slightly different aspect of this subject, if a central bank if a central bank takes in, say, Greek or Spanish government bonds as collateral, does that have any haircut, given that these are countries either in sort of close to default or in a very, very insolvent position?
Well, it's really up to the central bank to decide what its collateral rules are going to be. And as I mentioned earlier, sometimes central banks simply change the rules. And in theory, central banks they're their own regulators. So if the central bank says, yes, we are willing to buy this, whatever debt that's trading at 20 cents on the dollar, or 20 cents on the euro, whatever currency it might be, but we will effectively hold it at face value, I guess they could do that. And indeed, that's arguably what the Fed did in 2008 when it took on some toxic securities onto its own balance sheet. It simply didn't mark them to market because there was no market. So it took them at some assumed value, which I would believe, and I think most people believe, was an absurdly inflated value, which did not recognize what the eventual loss on those securities was likely to be. And in fact, in many cases, I think a lot of the stuff the Fed bought back in 2008 is probably going to end up being worthless when all is said and done. But in any event, because central banks do set their own rules, it's very likely that one way in which they effectively go about creating money and creating inflation is by acquiring distressed debt, but simply not treating it as such on their balance sheet and creating enough new money accordingly.
So that stores up problems for later.
Oh, absolutely.
Very, very briefly before we finish, what's your view on silver as a portfolio manager?
Silver occupies an interesting place in any commodity portfolio because it is one of those commodities that has dual uses. It's not true of gold, which really has only monetary and store of value uses. It has very little in the way of industrial applications, and to the extent it does, it's easily recoverable from those applications. That is, you can recycle gold very quickly and easily because just because of the way it bonds with other metals and things. Silver is different. Silver historically does have a claim to being used as money, and indeed did provide actual coinage as money historically, more frequently than gold. Gold was used more as actual bullion, silver used as actual coinage more frequently. But in this day and age, silver has a large and growing range of industrial uses, including in areas that most people aren't even aware of, such as certain biomedical applications, for example. And so those use silver, but they use it in ways which does not leave the silver easily recoverable, or indeed recoverable at all. In some cases, no technology exists to reconstitute silver from some of the uses into which it's now going. And so in that respect, silver has a very, very interesting demand function when you add it all together. It means that the industrial supply and demand can already be quite tight for silver. That is, you could already be clearing the market pretty much completely out of all production as you go along for these new industrial uses. But then what happens if you even get a small shift in the monetary or store of value demand for silver? A small shift amidst tight supply could have a very nonlinear impact on the price. I mean, that is what, marginal pricing theory tells us. And so the ability for silver to suddenly gap higher on an even small incremental increase in monetary demand is very substantial. And in that sense, silver has a certain degree of optionality vis-a-vis gold, say, if indeed we get a general shift in the monetary demand for precious metals. So I think holding silver in your portfolio is kind of like holding an option that we get a general shift in the monetary demand for metals, which of course would be associated with a shift away from the dollar, most probably. So I think holding silver is a sensible thing to do. Do I think it's suddenly going to scream higher in the near term? No, I don't. But the implied optionality is so valuable, I think it is arguably more attractive to hold silver for the, say, longer term than it is to hold gold exclusively.
Yes, I think that would be my view as well. John, where can our listeners find you? What's the best way to, apart from just Googling you?
Well, I do maintain a website at www.amphora-alpha.com. That is AMPHORA-alpha.com. And there is an archive of my Amphora Report newsletter there, and also some associated news items and other things that I consider to be of interest.
That is very interesting, and I have had a look at some of your articles, and you've been kind enough to send them to me in the past when you think they might interest me, and I can certainly recommend them to our listeners. John, thank you very much indeed for taking time out to speak to us, and we will watch the world with interest.
Thank you, Alasdair.
Thanks.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.